Welcome, everyone, to another exciting episode of the YouTube show and podcast, None of Our Businesses, where we accountants talk about the latest in accounting, tax, finance, and general business news, all from the perspective of accountants. Not just one, I'm Ty Carr, but I've got two other accountants with me to weigh in. With me today, Tammy Hess and Charlie Zigmund.
Hey, everybody.
And what we're talking about today, well, we're going to start with some follow-ups, following up from previous episodes. We've got new discussion topic on Facebook's name choice and the issues it's causing. We've got some follow-up from the ships, the ocean-going ships being stuck down in Southern California, stuck in the harbors. Are they sticking the right person with the fine? And we've got positive adjusted Ebitda from Uber. Is that a real thing? We've got Musk and Bezos being saved by Joe Manchin. Is tax on unrealized gains even a conceptually sound basis for taxation? And finally, when Kevin O'Leary trash cans a resume. All right, let's get this going. We'll kick it off today with Charlie.
All right, so I've got an article we can talk about from commondreams.org, which is a new source for us here on the podcast. But the article is called Hands Off. Varoufakis tells Zuckerberg after Facebook steals the Meta name from an anti-capitalist think tank. And so what's going on is, of course, Facebook's changing their name to Meta, and that's been in the news, extensively in the past week. We covered it on the podcast here, but this clashes with an organization that already existed, which was called Our Center for Post-Capitalist Civilization, and it's an anti-capitalist think tank. It's gone by the name Meta. It goes on a variation of the name Meta that is like M, and then it's the Greek letter E, and then it's TA. And what's happened is that, of course, Facebook has commandeered that name, and that has caused the leaders of that group, of the Meta think tank, to be up in arms. They've taken to Twitter, and they've really written out all of their, in all of their issues with it. And they've said, hey, we're at a crossroads. It's time to decide what we want the future of the internet to look like. And then it's time to fight for that vision before it's too late. I tried to get a feeling for what exactly they do. And the closest thing I could find in the article was a quote that said, "Through art, research, argument, and poetry, Meta works to break with a dystopic present to imagine the world anew." And so I'll let you, come to whatever conclusions you will from that. The thing that I thought was most interesting about this article was that as I thought about it, it's trademark law is supposed to be what protects companies from issues like somebody stealing your name. And so I was kind of wondering, why didn't that protect them here? And I'm wondering if it's because of their choice to use the Greek letter epsilon in their name. And maybe that was their ultimate undoing, which, if it is just hilarious to me, because it's one of those things that you do to be different and to be noticeable, but it has also set you up for this terrible fall from grace. And so I want to get you guys' thoughts on this. What do you think? Should they be allowed to take over that name, or what do you think?
Yeah, so I don't think that they should be allowed to take over that name because it is so close, and it basically made, if you're going to look at what you found what the company does, it's very similar in terms of the idea of what the word is that they're transforming and evolving into this great beyond or whatnot. But yeah, I would agree with you. Trademark laws should have prevented that. But I wonder, the other thing that actually, even to take the laws out of it, the fact that Facebook didn't think about that or look at that or even identify that as a potential problem and maybe get ahead of it before it is, because now I would say it is a little bit too late, because they did all the announcements, they did all this kind of stuff. So now you're going to be battling in, is this trademark infringement or not? And so it's going to be an interesting kind of next couple of weeks to months to figure out if they iron that out or how hard they're going to fight for it. And then the other thing to kind of add to that is, granted, Facebook did not do this because of their most recent negative press or bad press, but this is not going to help. This is just another bit of another negative press story that they're trying to, kind of get away and think about the future. And it's not helping, I don't think. What about you, Ty?
Yeah, I think building off some of what you just said there, it's hard for me to believe that Facebook didn't know, or somebody at Facebook didn't, they would have scoured that the earth for that name to see who else might be using it or whatever. And so it is kind of interesting, right? It's being used by an anti-capitalist think tank. And so it's like, what was the thinking at Facebook there? That maybe they just would not say anything or ignore it, or was secretly deep down inside, was Mark Zuckerberg and Facebook folks, were they up for the fight, where they were like, yeah, this is going to be fun, we're going to have a showdown with this anti-capitalist think tank over this name, because it's hard to believe they couldn't have seen this coming.
I think, but to your point, Ty, I think a lot of companies typically think that either A, it's unlikely that a company is going to fight it or not, because I do think that they've done their homework and said, there's a potential issue here, but they probably thought, hey, we're Facebook, we're going to win regardless, so let's just throw it out there and see what comes. But then I think you do have to, that's a risk that you play, because then when you do that, they might come after it, and then you're fighting a lawsuit and or just more negative press. And how are you going to resolve that? So I would say they probably did, and I think that they're willing to take that challenge.
And of course, this anti-capitalist think tank, this organization took to Twitter to make their case, right? They didn't go to that makes sense, right? They didn't go to Facebook to make their case. They went to Twitter to make their case.
No, that's exactly right. So it'll be fun to see how that plays out. And do you have another article we can talk about, Tammy?
I do. I wanted to provide an update on the article that Charlie shared with us last week on the 100+ ships sitting idle on the shores of California. So last week we were pondering on who bore the responsibility of the idling ships and who should pay for the fines if fines were to be imposed. Well, it seems that a decision has been made. Based on an article I found this week, the ocean carriers will be fined $100 per day for each truck-bound container that is left for 9 days or more. The Port of Los Angeles states that they already are seeing some progress since they've imposed these fines, and that people are working together to get things moving in the right direction. Now, times, will only tell how really effective these fines were and how quickly things get resolved. But I wanted to bring back to to put kind of a circle or close the circle on the discussion we had last week. And now that we know who's going to be paying those fines, but I wanted to get your guys' input on that. Do you think that this is going to be successful? Are they finding the right, person in this little issue that they're facing right now?
So wait, they're finding who? The carriers?
The carriers, the ocean carriers.
Yeah. So I go back to the question I had last time, and if this is working, like, what influence do the carriers actually have on getting their ships unloaded? Right? Are they, just begging their counterparts in the trucking world, or how's that incentive actually working?
I think that exactly what they're doing, because in the article, it doesn't say like how they're seeing the improvements that are being made or progress that's being made. But what they did say is that people are actively working together on a daily basis to do things. And I think that's to your point. All of a sudden, someone now is being forced to pay for it. That they're probably going, this is not my fault, but I'm not, not going to sit here and wait anymore. I'm going to make you figure out how to get it resolved. So now people are working together. So while I still think it's probably a good idea that someone's being fined, it is interesting that they pick the person, they picked the carriers and said that it's going to be up to you. You're going to have to pay for it. And now the carriers are putting the pressure, I think, on the other channels that are actually causing the challenge.
And as much as we may not like regulation, hey, one more example of the fact incentives work, right? They just do.
Mm-hmm.
Yeah, no, I think that them finding them totally makes sense. I think that goes back to just like who they were able to levy a fine on. It was easier to trace the companies that were doing that, and then it would have to like flow back through all the different layers and out to the people who had the goods. But it had to be costing somebody a lot of money to have all this stuff just stuck in the system in the first place anyway. So as I'm reading, I'm kind of thinking about like, well, if they were going to clear up everything because of that issue already anyway, it'd be easy to kind of take this as a correlation versus causation thing if that was about to happen. But I think it makes sense. Of course, having a fine is going to cause the wheels to keep on a churning, so to speak. So, yeah.
Awesome. Well, I got one here from TechCrunch, and the author's Alex Wilhelm, and he's talking about Uber. The title of the article is Uber squeaks a tiny adjusted profit in Q3 despite a $10.4 billion net loss. The details of this are interesting, but I kind of enjoyed Alex Wilhelm, the author. I enjoyed his sense of humor throughout the article as well, or his way of relaying the information here of what was going on. So, one of the and I'll kind of throw out some points that the author made in this, and then kind of get your take on this. And so one of the points was this concept of adjusted EBITDA. So essentially, that's not, Uber, there's what we call generally accepted accounting principles, which defines your financial statements and your net income. And Uber is basically creating this other kind of income they call adjusted EBITDA, which is fairly common in the tech world. And they're saying, well, they've got this adjusted EBITDA that actually shows they're doing positive. They've got $25 to $75 million of income, depending on the adjustments that you're looking at for adjusted EBITDA for this third quarter, where they otherwise on their kind of regular, what we call GAAP financial statements, would show a massive loss. And that this was one of the places I saw that the author had it was just a funny way of describing that. The author said, basically we mock the use of adjusted EBITDA for a grown-up company. This is the kind of stuff that's used by startups with their VC firms. It's, that at this level for this kind of company, the grown-up metric should be GAAP net income. And so maybe I'd pause there for a second and just ask, what you guys think about that concept of kind of the reporting and trying to make a case for non-GAAP income as a grown-up company. Is that really kind of a silly thing to do, as the author suggests?
I think it gets used I think it gets used maybe more than it should, or it gets used to justify things that it shouldn't. And so I do think that term gets misused, but I do think it is worth noting that like a company that breaks a benchmark of getting to positive EBITDA, like that is a milestone for that company. And it does mean something. It doesn't mean that everything's okay. It doesn't mean that they're profitable. It just means that you have to look further to understand what really happened. But I do think it's fair to use as a benchmark because it is kind of a stepping stone in a lot of these companies' lives. And a lot of the things that are in the sections being pulled out, so interest, depreciation, amortization, are not, they're meaningful, but they can be debatable in terms of how they should be applied. And so I can see why business owners often I don't want to say flock to this metric, but I can see why they look at that. And it's an easier metric to hit, right? So if you're having a company that's having a hard time, I'm going to look for whichever metric I can use to say that things are going okay. And so that's where I think it gets misused. But I'm curious to hear your take on this, Tammy.
Yeah, so I've seen this in not just only startup companies or new companies, but companies that are experiencing a net loss, for example, for whatever reason, and then they're trying to create a new type of net income to explain that it's not, here's all the things that were inside our control. And so this is what we want to report on, when there's actually, if you look at the financials, it's going to give it a different, kind of result and story. And so I would say that does make me laugh about the grown-up kind of viewpoint of it. And I would agree. I think that it is kind of, you have to explain the story regardless. So yes, you may say here, if you take these things into consideration, or you take these adjustments, here's what we were already looking at. We're feeling pretty good about it, but you can't ignore the fact that what the traditional GAAP, metrics and all those things are, they are what they are. So if you're needing to build a story about where your financials are, and there could be valid reasons for where, why you want to focus on a different metric, but just say what those are. You can't just focus on those. You can't be that's the only one you're going to really, pat yourself on the back for, because you're actually responsible for the adult version, which is the one that you're going to, people are really going to be looking at. So, and I know from experience that the other part too is when you create an adjustment, or you kind of create your own type of net income, and that's what you're reporting on, people who are in the business, working on the business, may kind of get confused and also not, and lose focus as to what they're supposed to be working on, or what they should be looking at, and how profitable or successful a company is when they've kind of internally ignored the traditional financial statements.
Yeah, I mean, that you guys have kind of summarized my view as well. And to add an extra wrinkle to this is that kind of what we've just been talking about, this difference between adjusted EBITDA and GAAP, this kind of pops out in the way the author described this in the financials. It pops out in thinking about the difference between this adjusted EBITDA and what they call, what is on their GAAP financial statement, their operating income or loss. Well, loss in this case, because their operating loss was about 572 million. So we're talking about the difference between the 25 to 75 million and 572 million in an operating loss. But for our audience, like if you're doing a GAAP financial, that operating loss is actually not the bottom line numbers. So if you keep going down the income statement from there, the actual net income or net loss of this company was in the billions. It was like 2.44 billion. And so, we were just talking a second ago here about that, EBITDA, adjusted EBITDA versus say their operating loss and kind of the meaning there. But there's an even further gulf between even the operating loss and this net loss. And another great line from the article was that one of the investments that they had was in an entity called Didi that was basically messed up by the Chinese government regulation, shutting some things down. And so the author said, well, essentially that gulf, that big difference between their operating loss and their net loss can be viewed as the Chinese government putting the company in the shitter. So I think that and so I guess the question I have back to you all then is, okay, set aside this discussion about EBITDA versus GAAP. Even within the GAAP statement, there's this different argument of, do we go with operating income or loss, or do we take into account these investment losses? Is it fair to say these investment losses just don't mean anything either? What are your thoughts on that?
I mean, I think that, to be fair to the GAAP financial statement, I mean, it does say that it does matter. It just needs to be further down. And I think there is value in pausing the discussion at operating income and isolating what the company's core activity is, and then determining how well they did that. And then I think it's a separate question to say, well, how did the company's investments do? Like I said, I think both matter. So I think that as a reader of the financials, you should be using the one which considers everything. But I think that it's fair or valuable still to stop at operations, because that's the one, at least the way I like to try to look at it, is that's the one we would expect to repeat more easily or more likely than things that go on in the other. But like you said, both absolutely have to be considered. And in this case, the ratio between them really highlighted that issue, because the amount they had made on operations, like you said, was tiny compared to what this other thing, dwarfed it completely. So yeah, it's very interesting.
I loved what you just said there, Charlie, a moment ago, where you said that you get to the operating and net income, you talk about that and you pause, have the discussion of what that means, and then you continue going forward. Because I 100% agree, the full financial statements all the way through, whether, GAAP or your internal and however you want to define it, all those things are important. But yes, maybe you do pause at certain highlights to talk about, here's where we were on a continuous, on normal operations, blah, 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 blah. And then let's go forward. Now we also have this other layer that's a one-off, investment loss and all these kinds of things. And this is what this means, and kind of go through, because I am a big believer that you don't necessarily just send out financial statements and leave that as it is. Financial statements should be used as a discussion. And there are, things that are key critical focus points, but then you also have to understand the full picture as well. So you have to, again, I'm going to probably say this over and over again now, Charlie, and seal it from you, but you pause, have the conversation, and then you continue forward and you continue to get the complete picture. So that was great.
Yeah, that is great insight. I love it. And so, the final thing I want to say about this is not technical at all, just an interesting observation about their business. Something that came out in the article that I didn't know, I'm a user of Uber, but I didn't realize that their food delivery business is outpacing their mobility, what they call their mobility business, or the taxi, the classic taxi type business that they have. So yeah, that was interesting. And it seemed to have been brought on perhaps by the pandemic, but yeah, love if you have any closing thoughts on that point.
I think that makes total sense, Ty, because if you think about it, especially during the early stages of the pandemic where things were shut down, people weren't going anywhere. And also being locked in a car with somebody else, mask or no mask, and all those various different things. I think that it was definitely slower. But what did go up was, since we can't go to restaurants, we're having food delivered to the house, right? So that does make sense. It's a very interesting thing in terms of always being able to pivot and doing things and really being able to address the needs of the time. And in that particular sense, I think Uber did a really good job.
Yeah, and I'll just throw in one last thought on that before I transition to the next article. I think that when they added that service, everybody was already using Uber, so it got the benefit of all the synergy of people having already been in the Uber ecosystem, and so it's easier to add something to your service than it is to start it fresh. And I think that's part of it, but I think all of that is true too about people eating at home. Just kind of talking about these same sort of topics. I've got an article here in Forbes called How Much Elon Musk and Jeff Bezos Saved After Joe Manchin Scuttled Democrats' Tax Proposal. And so I'll try to not get lost in the title there and say that basically there was a proposal to tax billionaires on unrealized gains of capital assets. And so basically that had been put up for discussion, and then Democrats have now backed off of that and reverted to what they're calling a surtax on rich Americans, just on the income, not on the assets that they hold. And, this comes from a lot of anti-billionaire sentiment and a lot of calls to try to close the wealth inequality gap and that kind of a thing. And the article takes a look at a couple of key players like Elon Musk and Jeff Bezos and how their tax situation would look under these different proposals. But for me, the interesting thing is I think that a lot of people, as much as we want to close this inequality gap and we want to tax the rich, those are like generally like things a lot of people do want unless they are the rich. I think this idea of taxing unrealized capital gains is something that a lot of people don't agree with in theory, like this idea of like, how can I pay a tax on money that I don't have? And I think that it's just interesting to try to balance those two things, right? Because we want to tax the rich, but we also don't want to accept that we shouldn't pay taxes on money we don't have. And so I want to open it up for discussion on with you all on just about, is there a way to kind of walk that fine line on those two conflicting ideologies, or how should we? I know it's a big question, but any thoughts on how to successfully close the wealth inequality gap, I guess?
Yeah, I mean, I think, unfortunately you get into the politics of it, right? To say, if we kind of talk about, there's the question, should we close the wealth inequality gap? Do we believe that's a thing and that it should be addressed and all of that? And I'm not afraid to say here that I do think there is a gap there and it should be addressed in some way. But I think you can sidestep the politics of it to some extent, looking at it just from the lens of, is taxing unrealized gains conceptually sound? Regardless of, because it still gets political because the group of people most likely to have these unrealized gains are going to be the wealthy. But in any case, as I often like to do, steer the question towards an academic question. Is an unrealized gain a conceptually sound thing to be basing tax on? And I think, that is that has been a cornerstone of U.S. tax policy for a very long time. The question of this idea that realization is necessary for taxation, that simply, how you determine whether there actually is income, conceptually speaking, is that there is what we'd call a realization event. And so this whole idea, this whole tax law proposed here really turned that on its head. And I think, and so before we get excited about what it could mean in terms of closing the wealth inequality gap issue, this could have legs, right? We turn this concept on its head, it could eventually have legs in unprecedented ways. I think I'll actually steal from you, Charlie, because you mentioned it offline here. If we accept this idea, then what does that mean about how we think about Bitcoin investors, right? And so I think that is something people should take into account. It comes down to this fundamental question of, if you have any asset at all, anything that you own that's not cash, that has simply increased in value, should that be a taxable event, or should it be that you had to have somehow realized that value? And the argument to say that it should not be a taxable event just because you own something that theoretically increased in value is, until you actually transact with that item, until you trade something for it or have an actual exchange of that item, the idea that it increased in value is actually just a theory. I mean, you don't, and so it's I think it's a slippery slope on that end, and it could very well decrease in value before you actually engage in any transaction. And notice my language, though, I'm being careful. I'm not saying that you have to get cash to have a realized transaction. I'm saying that you engage in some sort of exchange. I think there's all kinds of ways in which you can recognize the value of an asset went up for you, where you trade for something that isn't cash. So I think we're talking about two different things. An unrealized gain suggests that you haven't engaged in an exchange that realizes its value. That's different than that's different than saying that you haven't sold that thing for cash. That's a different level of issue, right? So I can exchange my asset. I can take my stock portfolio, and I don't know, at some point I might be able to sell it for Bitcoin or sell it for a crypto or exchange it for a different stock portfolio. The fact that I engaged in that transaction suggests that I'm realizing the value of that in some way, because I'm getting something else back in value, albeit not cash. I do think there is meaning to that, even if it's not cash. And I think this is where you get like the complete opposite ends of the spectrum, where on one hand we're saying, oh, you haven't done any exchange of that at all with this asset, and you're going to say that simply its theoretical value went up, therefore we can tax the unrealized gain. I think that's on one end of the spectrum. And then on the other end of the spectrum are the folks who say, well, you can't tax it at all because you didn't exchange it for cash. And I think, I don't agree with either side of those. I'm basically saying, I don't think unrealized transactions should be taxed, but I think that this concept of realization has more to do with exchanging for anything of value, not just cash. I'll throw it out to you guys, see if you can see what you can say about that.
Well, I don't know what to say about that, but I will say when you were explaining that, I was really engaged in listening to you explain it really well, because that is 100% true. Where when I first think about it, my first initial thought when I was reading this article and kind of looking at the table, like the Excel table the table that they show there, where it's like who's paying what in taxes and what would they pay under the current system and what they would pay on the new system. I was fascinated by that, because there is some sense there where you're like, you see a few zeros where people aren't paying taxes and stuff, and that they're worth a lot of money. So you're trying to figure out, does that seem like that's right or not? But at the same time, when you were just explaining your position, Ty, it's true. Maybe, you shouldn't be, paying for something that you did not realize. But I do agree. It's not the necessary cash is what makes it realize. It's actually with an exchange of an asset or any of those types of things. But how do we, I guess the bigger question for me is how can we fix the gap? Like, where is it where we do see some movement in the fact where the richest of the rich are paying similar percentage of taxes as, some of the other folks are trying to figure that part out. And I don't have the answer to that. I just know that is probably where a lot of people are struggling and trying to figure out what is the right way to do it, to try to get kind of the tax equality, if there is such a thing out there.
Yeah, that's the billion-dollar question, so to speak. And I don't pretend to have an answer for it. I just can only kind of talk about it here and, share my thoughts. But yeah, I think it's something a lot of people struggle with it on whether, how to apply that theory. And, there was some pushback. There was a number of billionaires that pushed back on it. Trump denounced the bill and said that he's going to go ahead and move out of the U.S. if this is passed. So I'm all for it. It's a great law. And, I just think we should get that on the books whenever we can. The other question I had just as a point of discussion is like, well, if we're going to tax unrealized gains, do we get to deduct unrealized losses? And how do you kind of govern that? Because I can totally imagine, speaking of Trump, I can imagine all kind of philandering that could happen if we were to start taking unrealized gains somehow into account. And so, yeah, I think it's an interesting topic for discussion. Do you have another one we can talk about, Tammy?
So, yes, I do have one. And the title is, When Kevin O'Leary Sees This Resume Red Flag, I Simply Put It Into the Garbage. So there are many different things that employers look at when they are reviewing a resume to determine if a potential candidate is a good fit for the company. Kevin O'Leary, a well-known businessman and one of the stars of Shark Tank, states that there is one thing that will cause him to pass on a potential candidate: if they have multiple jobs over the past 2 years. And I'll quote him. He says, "I simply put them into the garbage because we are not going to look at that person." A survey by TalentWorks has supported this notion that those with short employment stints are 43% less likely to be hired. However, there are others who believe that employers are becoming more flexible when reviewing resumes. Some believe that having a long tenure with a company provides some cover if followed by one with a short stint. Harvard Business Review also says that it's become a part of life for employees to jump between jobs, and employers are actually less likely to hold it against them as they have in the past. So I know I've looked at a lot of resumes over the past few years, and I've noticed an increase of resumes with a lot of job hopping. And while it's not necessarily a deal breaker for me, it is definitely something that I will inquire about. So I was kind of curious to see what your thoughts on this would be. Is it truly something that employers are no longer taking into consideration, or is this still something that a potential candidate has to overcome and or address?
I think it can be it's very circumstantial from my standpoint in terms of where is the candidate in their overall career. Because if I see that with a pretty experienced candidate, I know for my own, I just look at it for my own sake. Like, I'm not an employee, I'm an entrepreneur, so I'm not on the employee side of this. I'm generally doing the hiring, but I think about my own kind of career path and retirement. As I get older these days, I'm always kind of starting to think more and more about that kind of thing. And one of the things that comes to mind is, I don't want to be wasting time in a situation that's not good. And so I think I know this from on the employer side. I subscribe to that saying, and I hear Gary Vaynerchuk say it, but I'm sure other people have said it too, in the sense of, hiring is guessing and firing is knowing. And, if that's true for me as an employer, then that's true for an employee too, right? And so I think that there's some things like, I guess the way for me to describe this is to liken it to our own industry, which is, if you're starting out as an accountant and you're going to go work for a public accounting firm, and you've concluded that in most markets, there's kind of a set of public accounting firms that are known, that are kind of the local regional firms. And then of course there's the big public accounting firms. And for the most part, you kind of know what you're going to get in those situations. So it doesn't really make sense that you would leave school and only work for 6 months to a year for one public accounting firm and then jump over to another one for 6 months to a year, because the experience that you're going to have in that setting in the first part of your career is going to be pretty similar across the board. And yeah, you can sit there and say, legitimately, I might agree with some folks that say this. You can say, well, that experience kind of sucks in a variety of ways. Well, it kind of does, but you have to expect that it's going to suck all the other places you're going to. So hopping around firms at that level and at that point in your career really just doesn't make any sense, because what you're trying to achieve by changing jobs is not practical or realistic, in my opinion. You're not going to find like the holy grail of accounting firms that, your first year out of school, and that's the one that you're going to want to stay with for the rest of your life. Your goal at that point in your career is to get some skills under your belt that give you value and allow you to move on. Now, context is everything, right? I mean, you could be an unfortunate soul that ended up in the worst possible firm, and it really was advisable for you to get out as soon as possible. Maybe, right? And so we can't discount that possibility. But I think you have to consider kind of what I was just saying about, where are you in your career, and what does this mean, and what were you trying to achieve by changing jobs? I think it's different if you look at somebody who's maybe highly experienced as a controller, or you're getting, you're farther up the ladder. And particularly what we see people who are working in kind of startup companies. And I mean, when you join the executive team, if you're at the executive ranks, when you join the executive team of a business, you're really signing on to your belief in that business. And there's a lot that you can't know from the outside. So I think it's totally legitimate for people at a much higher level to sign on, see what they got into, and then if it's not going to work, move on, get out of there. It's not good for you or the company for you to be participating as a leader in that company just because you want to make sure that you don't have less than 2 years on your resume, right? I don't think that's a good answer. I think, and it's reasonable. That goes back to what I said before. If the employer is just guessing, then that executive who was taking a job was probably just guessing too. And so both of them needed to figure out if this was the right fit or not. And so I think there's a lot of possibilities in between those two kind of scenarios, but I kind of describe it that way just to give a sense of my point, that I believe that it is circumstantial as to what that actually can mean when you see people kind of changing a lot of jobs. And the last thing I would say is that I struggle with this because of what I said earlier, because I'm the entrepreneur, I'm the one who's typically hiring. And so sometimes I put my own circumstances off on to the employee in the sense of, I look around it and I'm like, yeah, I can see myself not staying in a particular job for too long if it's not fitting my needs. But that may not be the right way to think about it, in the sense that I'm not hiring myself. I'm hiring people who are wanting to be employees and who want to work in a company. And so, I can see the wisdom. I can see where sometimes my thinking is a little bit faulty on this, in the sense of, I can see the wisdom of, if you're hiring from a group of people where one of the primary values of that group is their contribution and loyalty to an organization, then you should see that bear out in their resume, right? So yeah, those are some very different and desperate thoughts on this subject. As you can tell, my mind is absolutely not settled on this issue.
No, it's a hard topic that has, I think, really good arguments on both sides. I mean, on the one hand, employers want to be able to invest in an employee, and they don't want to put in a bunch of money or time trying to train somebody up only to find that they're going to leave, right away. But I think at the same time, like you said, it's totally true that you have a lot of times legitimate reasons for leaving, and you're guessing when you're getting hired, and you don't know what the firm is going to look like. And sometimes it's the right thing to not arbitrarily plunk down 2 years of your life onto a resume just to get that, that benchmark. Where I think the tricky thing becomes is if the job getting posted for has applicants that has enough people coming in, and many of them have the characteristic of having long-term tenures, and then some don't. Even if the reasons are justified for why the person might have left, it may never come to light about why they left, because as long as you've got a glut of people to pick from, you're going to pick those who maybe don't have that issue. And I know for me, even as not somebody in the entrepreneurial role of having hired for that job, but just when I'm evaluating coworkers that I may hire in an employee role, I do think about, should I invest any effort into this individual, or do I think that person is just going to fly by night and get on out of here? And if so, I think both are fine. If either one is fine. You just need to know what you're getting into, and then cater your interactions with that person according to, it's kind of like any investment decision, right? You look at your time horizon of how long you plan to do that thing. And so for me, working with other people who I think are about to leave would be like not investing in that person. And so, yeah, I think it's totally healthy to do on both sides, but very difficult to do correctly to evaluate that. And so, yeah, those are my thoughts.
I think you guys all had really good and interesting thoughts. And I do think it's one of those things where a resume, unfortunately, there's a commercial out there. I don't remember exactly what it's a commercial for, but where it talks about bringing a resume to life. Like the resume just tells you the bullet points and you don't get the story. And there are stories behind some of those things. When Ty was explaining some of his examples, I think another example could be there's, unlucky people who find companies and they get on board, and that company that sells or merges or goes out of business, and then they go to the next company, and then that happens again. So it's the actual change in jobs is not their fault. They were fully committed and really wanting to work there, but then something changed outside of their control within the company that changed their position. And so I do think it's one of those things where it is worth the time to probably look at and talk to and see if there is a solid story, and to kind of get there. But to Charlie's point, you're right. If you have, 100 resumes and you have all these, other ones that, maybe have long tenures or average tenures or whatever you want to look at, or whatever you decide is important to the company, you may not even get to those people because you already have enough, number of pool of candidates. But what I will say, which I think is the article didn't mention, but I do think it's another interesting factor, is the fact that right now people are trying to get anybody and hire anybody on jobs, regardless of what industry things are in. And so I do think that some of these things where you might have been a little bit more pickier about, okay, well, they only had 2 years. Well, Kevin O'Leary actually says that he looks for someone that's less than 2 years, which is less than 2 years is, quite a bit of time in that sense. But that's not quite as job hoppy as like 6 months or 3 months or 2 months that we were talking about. But I think that a lot of employers are looking and kind of being more forgiving about certain things like the job hopping, or even like, if you remember back in the day where everyone didn't want to have a gap in their resume. So they didn't want to show like a year of not working without having to explain it. I think those things have kind of, those viewpoints have changed, and people are a little bit more willing to kind of overlook that or ask questions about it and things of that nature. Plus, the other thing I was going to add to that too is that as the world changes, where we're a lot more mobile and people are moving from place to place, and especially if they are not able to work remotely, you might see a lot of job hopping from there, especially in the younger work group, where they are definitely a lot more mobile. And you'll see a resume where that's like they do have 10 different jobs within the last 5 years, but they also have 10 different states in the last 5 years, which will still bear questions, as they plan on staying in your state for very long. But it is one of those things to kind of discuss as times change.
All right, everybody, that's been our show. Thanks for watching. Thanks for listening to the None of Our Businesses YouTube show and podcast. Tune in again next week for more business updates from an accountant's perspective. And also check out our sister podcast, Profitless on Purpose, where they discuss anything and everything relating to the nonprofit space. Thank you.
Bye.
Bye, everyone.